Welcome to Thoughts on the Market. I'm Michael Zezas, Global Head of Fixed Income Research and Public Policy Strategy. Today, we're talking about a proposal tucked away in U.S. tax legislation that could impact investors in meaningful ways, Section 899. It's Wednesday, June 11th at 12 p.m. in New York. So, Section 899 is basically a new rule that's part of a bigger bill that passed the House. It would give the U.S. Treasury the power to hit back with taxes on foreign companies if they think other countries are unfairly taxing U.S. businesses. And this rule could override existing tax agreements between countries, even applying to government funds and pension plans. The immediate concern is whether foreign holdings of U.S. bonds would be taxed, something that's not entirely clear in the draft language. Making the cost of ownership higher would affect holders of tens of trillions of U.S. securities. That includes about 25% of the U.S. corporate bond market. In short, the concern is that this would disincentivize ownership of U.S. bonds by overseas investors, creating extra costs or risk premium, meaning higher yields. The good news is that there's a decent chance the Senate will tweak or clarify Section 899. Consider the evidence that the motive of those who drafted this provision doesn't seem to have been to tax fixed income securities. If it was, you'd expect the official estimates of how much tax revenue this provision would generate to be far higher than what was scored by Congress. Public comments by senators seem to mirror this, signaling changes are coming. But while that might mitigate one acute risk associated with 899, other risks could linger. If the provision were enacted, it acts as an extra cost on foreign multinationals investing in building businesses in the U.S. That means weaker demand for U.S. dollars overall. So, while this is not at the core of our FX strategy team's thesis on why the dollar weakens further this year, it does reinforce the view. For European equities, our equity strategy team flags that Section 899 adds a whole new layer of worry on top of the tariff concerns everyone's been talking about. While people have been focused on European goods exports to the U.S., Section 899 could affect a much broader range of European companies doing business in America. The most vulnerable sectors include business services, healthcare, travel and leisure, media, and software, basically any European company with significant U.S. business. The bottom line, even if modified, if Section 899 stays in the bill and is enacted, there's key ramifications for the U.S. dollar and European stocks. But pay careful attention in the coming days. This provision could be jettisoned from the Senate bill. It's still possible that it's too big of a law change to comply with the Senate's budget reconciliation procedure, and so would get thrown out for reasons of process rather than politics. We'll be tracking it and keep you in the loop. Thanks for listening. If you enjoy Thoughts on the Market, please leave us a review and tell your friends. We want everyone to listen.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.